ahead and set up mine, of course. And are you going to see the little posting?
I mean, I think it will pop up.
Yeah. Well, meh.
If I see yours first, I'm going to share from yours.
All right. Well, I already see it. So.
Oh, I see it too. Okay. Gotta scroll down.
I'm going to share it with my story and then share it to my posting. And just double checking just to make sure that we're not having any issues. We are here. All right, good. We're here.
Yeah.
What's up, everybody? It's going to be interesting to see who all up from the Sneaky fam. I wonder who's all going to be from Skiki. Did you share it with your folks, Antwoine?
I did.
Oh, man. Oh, here we go. How many folks from the Shire are we going to get through here?
Who knows? You know.
Island.
We got Kay Cole in the building. Shout outs to Black entrepreneurs, especially within general contracting and development.
Hey, Ranny.
Ranny's in the building.
Let us know how your portfolio's looking.
I know, right?
I haven't seen a screenshot in hella.
Oh. I just wait for the reports. I just wait for the praise reports. What's up, Linda?
Hey, Cole. Hey, y'all.
Yo, I'm excited for today. Like today's gonna be. Oh, look at that! I even got the little come up logo on the watch. That's kind of. You know, it would be dope if you could listen to live streams through. What's good, Kamari? What's up, Rubel?
Hey, Kamari.
It would be super dope if you can listen to these things through the watch. So like you can listen to like live podcasts and everything else through your watches.
Hi, 10. 10 for my possibility. Shout out.
People do live podcasts? Is that a thing?
That is a thing. That is definitely a thing. I'm probably sure that not everybody's able to get in like at the right time, but I'm probably sure that they're there for the they're definitely there for the after, I guess, the recording version.
I feel bad. I have a buddy who's a founder of a company, and his name is Rudy, but the name of the company is slipping my mind. It actually is a platform that just allows you to broadcast. If we were doing this live on Facebook, you could broadcast this across 6 or 7 different platforms simultaneously. All from.
I wonder if that's StreamYard or something like that. I had a well, it probably may not have been him, but it's like maybe 6 months ago, 8 months ago, I had a pitch deck sent to me.
Switchboard Live, that's the name of it.
Okay, now I have heard of that one.
Yeah.
Nice. Yes, everybody, I haven't gotten any of the Come Up merch yet. It's definitely coming.
On the way.
But for now, I'm wearing my National Sarcasm Society. Like, we need your support. We got Anthony Malik Thomas in the building. Thank you for joining us.
Give your water.
All right. Yo, I got so tired of y'all coming for me, so I got 2 of them. So we're here. Everybody like started sending me these messages talking about, is your throat parched?
Yeah.
All right.
Oh,
it's 5:05. So at that point, I hand it over to the wonderful Miss Joel NGC. Take it away.
Good evening, good afternoon, wherever you are. To Come Up. I'm your co-host, Joel NGC, along with Mark Monroe, and we have a special guest today. You'll hear from him a little later. We have Antwoine Fisher, Ph.D. in neuroscience. And
you mean Flowers, Antwoine Flowers.
Me. Oh my
Freudian
God.
slip.
Yes, Antwoine Flowers, excuse me. And he has a background in quantitative analysis, or excuse me, analytics. And he was a program director. Mark was telling me you were a program director for a startup accelerator program. Was that on the East Coast or Midwest or?
I was in Cincinnati, Ohio, the Hilman Accelerator.
Okay, cool. And now you are a data scientist at Google. And we were just talking about his passion for health, and hopefully he shares a little bit more about that as far as like the future of health goes. But we'll come back to you, Antwoine, in a moment. We just want to talk about first, the Dow was up by 131.14 points. S&P 500 was up by 13.43 points, and NASDAQ was up by 74.89 points. It was a green day, although the sector had a sell-off towards the last moments of the market. But for sector performance, obviously tech was up. We've seen that trend. Tech for the past few episodes, tech has been in there for sector performance.
It's the future.
Yeah, followed by consumer discretionary and health. So this is completely awesome that you're here with us, Antwoine, because you know the health sector was really holding steady. There wasn't really a sell-off today for them. And then our bottoms were utilities, consumer staples, and our real estate. And I will note that the VIX today, it's starting to come down, but it's still pretty volatile at 31.37. So with that, I'd like to now talk with you, Antwoine. Tell us, first of all, thank you for being here, number one.
Yes.
Thanks, Mark, for the invite.
For taking the time out. We want to know like what your investor story was. How did you get started?
Well, great to be here. Great to talk with all you folks. So I graduated from college in 2008, and when I got home, I had a job in the pharmaceutical sector. I was a biology undergrad, and around August or September, I remember seeing, we had this big screen in the hallway that just had, you know, the stock price of the day, the Dow, the S&P, things like that, like, you know, nothing crazy. And then that was the month where you just saw red every day. And then day after day, you would see people standing in the hallways, staring at this screen. And me, you know, fresh out of college, of course, I knew a little bit about the market, not a lot, but it was changing the world, right? It was having an outsized impact on my world every day. So that's when I started watching, you know, CNBC. A funny story, I actually really got deep in the stocks through Jim Cramer and Mad Money. Like that was my start. So shout out to Mad Money.
Shout out to Mad Money.
You know, for giving me a start. And then I picked up a ton of books on like technical analysis. That was kind of more my speed. Hopped on TD Ameritrade and started understanding, you know, volume flows and what the VIX was and options trading. Got into futures trading for a bit, and really just kind of, you know, fell around until I found, you know, strategies that worked for the long term. Played with some trading here and there. And now I'm mostly, I guess, a mature trader today. I try to look at, you know, trends and structural shifts and not really try to play it on a day-to-day bit anymore.
Okay, so would you identify, you said a mature trader, but for long-term, so would you ever consider yourself more so on the investor side, or are you actively trading?
Like I think I'm probably 70-30 investor trader. Just because of the demands of my day-to-day job, it just doesn't allow me to do the amount of research that I think is required to kind of trade, I guess, trends that are shorter than that. You know, I can't sit and really read, you know, all of the investor documents that are coming out for any particular company and try to arbitrage like that.
So, given what you just shared, what if we took a look inside of your portfolio right now, what companies would be?
Probably much like everyone else's right now. You'd see a lot of tech. I try to balance it out with healthcare companies and retail. So for me, I look at understanding what happened in March, understanding that a lot of value got taken off of the table, and a lot of the flows went into pretty much the Nasdaq and a couple stocks in the S&P 500. I started looking for opportunities, and for me, one of my favorites is luxury retail. If you look at the story of the last recession, LVMH, right? They own so many brands that are really just resilient, because unfortunately, when we see these types of dives in income, it really doesn't affect the higher tier spenders. And so, you saw Ralph Lauren take, a pretty significant hit. I think they went from 130 or 140 down to $70. Like, is Ralph Lauren really about to go out of business because people aren't shopping? No, like as soon as these stores open back up, you're going to start to see a lot more growth. Now, I think one of the things that's holding some of these brands back is that they really focused so much on the in-store experience and weren't really focused on, how do we deliver this value to customers that have to stay at home. But I think you're going to see, once tourism starts to come back, especially international tourism, you're going to see brands like Louis Vuitton and Gucci and just go back through the roof in terms of sales. So, really just looking for opportunities of value like that. And then with the airlines, I got a very big position in Southwest. Seeing what happened in the airline industry, I said, hey, Southwest doesn't depend on business travel, doesn't depend on international travel. So they're a lot more resilient. They're going to come back a lot quicker because a lot of those regional routes are already active. People are going to visit family while may not be going back to Disney World and things like that. So really just trying to find opportunities of value in the market that aren't, where everybody's already piled money, right? Which is pretty much Apple and Amazon.
So where do you see opportunities in the health sector?
Well, healthcare is one of those things that actually went up through this. I think that's one of the things that, people saw right away, was that no matter what happens, the government's going to be just pouring money for vaccine development, any type of technology. I actually, if you want a nice healthcare play, Microsoft is actually, funny story, a pretty good healthcare play. I think Apple is a pretty good healthcare play. I think Google Alphabet is a pretty good healthcare play. So my work day to day is in cloud services. And when I look at, what trends this is accelerating, we're doing a lot of work with the Mayo Clinic, Cleveland Clinic, to move into to increase the speed of their digital transformation, because you got to see your doctors online now. You got to see your primary care physicians online. So it's accelerating a lot of these healthcare trends. And so while like the biotechs and the pharmas are going to see a temporary pop because they're getting a lot of money to do this research, at the end of the day, only one or two of them is going to get a vaccine to market. And so you're actually going to see a lot of flows out of those. So, but what I like to look at are the technology players around healthcare that are kind of enabling the future of what it is they're doing, because they're going to be doing that work for years.
How does your background is really interesting. So how does your background inform your investment decisions? I imagine, you just see charts when you sleep, when you wake up, data. But how does that inform your investment strategies and just your approach?
Funny enough, it does, but not in so much as technical charts and machine learning models and things like that. I think, I got my PhD in neuroscience, but while I was doing that, I also was studying applied technology entrepreneurship. So I've always had this dual focus on developing early stage technology and then deploying that to the market. So I always kind of saw those two things as something that had to happen in unison. And so when I look at, how technology is going to fundamentally change industries and how it's going to enable new markets and how it's going to fundamentally change business models, I think that's what I try to understand. And really, I kind of play in the areas that, I could kind of wake up and talk for hours about. I want to put some money on Virgin Galactic, but it's not my space, right? Like, I don't know where the safe bet is in the space right now, but I have a space ETF. So like in my investment strategy, when I see trends, I think a space ETF is like a very safe bet right now. Will I make a play on an individual company? Probably not, right? Because once again, I don't have the time to kind of sit and do that research. But I see where the trend is going. I mean, and even if they get one tourist in a space, you're creating a new industry there. So like, that's definitely a place that you want to be right now. So yeah, I really kind of look for emerging technologies and applications of those emerging technologies, and then I kind of watch those trends. Like blockchain was a big one, and if you're familiar with the hype cycle, it's basically a new technology comes out, and then everybody's like, it's gonna change the world, and then it kind of disappears for a bit. That period after the hype and when it's disappearing is when people are actually finding meaningful applications. So that's actually when you want to be doing a lot of research, like what are we using blockchain for and which companies are really using it and how is it going to impact these business models. And you kind of want to make a play around that because those are going to be the ones that the institutional investors are like keeping in their back pocket for a rainy day.
So tell us about one of your like worst trades and what you learned.
Was it? Don't say it was the Facebook IPO that we did together.
No, I learned a lot from that. I learned that you have to have a lot of money to play in those ball games. My very first trade. So funny story. My dad used to work at IBM, but after IBM he went to Lucent, and then Lucent ended up getting acquired again by IBM, which is this funny thing. And while he was at Lucent, he was like, you should get some Lucent stock. You should get some Lucent stock. It's at like $2, and Lucent's not going out of business. Like they make critical software components, et cetera, et cetera. So that was my first trade. I might have had like, $400 or $500 to put into it. And I'm like, you know what, I'm going all in on this. And I think Lucent went from like $2 to like 30 cents before it was acquired by IBM for 60 cents. So I still ended up taking a loss on that. And there's a funny saying, and it's happening now, so I'm glad you asked, right? There's a funny saying. It's like when your barber starts giving you stock picks, it's time to start buying gold. So when I got buddies now that are calling me, great friends. I hope none of them are on this call. They're calling me, and they're like, I'm about to start trading. Like, I heard so-and-so is making a lot of money. I'm missing out. That's the point at which there's so much speculative cash in the market that like it's just noise, honestly. And you really want to start hedging your bets. So that's what that was my worst trade, and I learned a good lesson from that.
So we have some questions here. Rubel wants to know, what goals do you try to hit with investing in a full-time job each year?
Yeah, so I just got engaged recently.
Oh, congratulations.
Thank you. And so
Mazel tov.
Thank you. My fiance and I get annual bonuses. And so, we took a portion of those, and I said, we have this little competition where we say, okay, we're going to take, X amount of dollars, and we have to grow this by however many percent, right? And then, whoever loses, the other person gets their growth to do whatever they want with. I mean, sometimes she goes and buys nice shoes because I'll lose, and sometimes, I'll go get some Yeezys with her winnings. I think that really helps hone us. But yeah, I think my goal there really is to just not try to beat the market, but beat myself, right? I don't really focus on external goals like that. I think for the most part, when things are steady and we're in a bull market, I'm mostly in sector ETFs. I have no reason to try to like outthink, institutional investors know what they're doing. I'm going to follow the big money flows. I'm not going to try to outthink anybody. And then I'll have 10% of my portfolio in speculative trades just because my ego is telling me like SpaceX is going to kill it this year. You know what I mean? So like those are just stocks I have so I can call Mark and brag, but for the most part, I'm sitting in sector ETFs. I'm sitting in, I got my 401k most times is in a target date fund. Because I used to work in finance. So I was at an asset management firm at Nvidia. I was a quantitative analyst at Fifth Third Bank. And so I understand how much work goes into these models. I'm just gonna follow the smart money most times.
Awesome. Well, we have another.
He's got another question.
Yeah, from Let's see. As a new investor still in school, I would like to know what were your first resources when you began to invest right out of school?
Mm.
Like I said, the first one was Mad Money, and so here's what I took away from Jim Cramer: do your research, do your homework, and have a balanced portfolio. Understand what a balanced portfolio looks like. It used to look like this 60-40 bonds equity. That's no longer the case. The fundamental rules have changed. If you are an investor, I mean, I'm not gonna buck the trend here. I say start with Benjamin Graham, the Intelligent Investor, just so you can get a baseline understanding of what equities are, and what you're actually investing in companies. And then I would go to the website Finding Alpha. Great website that really helps you understand how the markets work. And I think that's the route I would go, right? I would understand how stock picking and research works. I would then go to like understanding how companies work, how they grow, how EBITDA is generated, those types of things. And then I would move to understanding how the markets work, because that was one of the last things that I figured out. So when I talk to you about, institutional flows, it was later in my career that I realized that, like, pension funds and 401k funds are the biggest guys moving the market. They're the ones buying these massive pops of equity. So when you see all these pre-market trades just shoot the market up, like, that's what's happening. People are buying huge plots of stock at different times of the day. And it kind of helps you understand, what's going on and why money is moving the way it is. So when people are closing out their trades at the end of the quarter and then rotating into bonds, that is a yearly thing that happens cyclically. You can predict that. So those are the types of things that you don't really have to worry about if you're a long-term investor. But if you're trying to play the trading game, then you kind of need to understand, equity flows.
All right, so Mark, I'm gonna kick it to you, and as questions come up for you, Antwoine, I will ask them away. But now we have some picks, Mark, right?
Oh man, yeah, let's do it. All right, so let's go over to the charts, and in the first trade that we have is we have Nvidia. So for those that don't know, essentially Nvidia is a semiconductor company that focuses more so towards data centers and graphics. They make a great deal of their bones through their graphics card industry, but their data center division has been killing it over pretty much the last 3 years. So you guys know typically how I do. I like to show you the year to date and go all the way up to the 5-year chart. But one of the things to look at is that Nvidia stands a lot to gain in, say, for example, Intel's losses over its loss of, say, for example, market share in the data center space, along with what they're doing in the driving space. So I don't know if anybody's heard lately, but a little bird chirped in my ear earlier today about Nvidia and Mercedes getting into business, along with some other companies joining the team and using Nvidia Drive's platform. Now, for those that don't know, Nvidia was very, very monumental for, say, for example, Tesla in its early days of autopilot technology. Now, of course, Tesla and Nvidia have gone separate ways, but I mean, Nvidia is going to be a major player moving forward, as well as what they're doing in the gaming space, not only just for graphics cards, but also what they're utilizing in the cloud space of their GeForce Now platform. So thus making it easier for folks to play video games, especially during coronavirus COVID-19 days. But then when you think about esports, e-gaming, they're becoming a major player, especially with their chip for gaming, which is their Tegra chip. So let's just take a quick look. So here's the 1-year chart. And I typically like to say, like, the tail of the ticker typically tells the story of where a company has gone. So this is a 2-year. Here we are at 5 years. So that's pretty healthy. I mean, of course, we had some low periods during this period of time. I think this was around the same time when we saw this drop in 2018, where we started hearing issues about the trade war, as well as some unbalancing and inflation and potential recession on the horizon. So this was back in December. But then after that, like any other company in the market, it had a beautiful 2019 recovery. Then here we are at the beginning of 2019 or 2020. Then we had pretty much COVID-19. And then ever since then, it hasn't even looked back. Short-term play, bullish. Mid-term play, bullish. Long-term play, bullish. I mean, that's pretty much across the board. If you guys have any of your brokerage accounts, you guys can pull up analyst research reports, and they pretty much, I mean, I think the majority of them are at a buy rating, if not outperform. Any questions so far?
Nope.
Ha! Okay, let's move it on. My next company is Best Buy. Now, I don't want to give it away too bad, but here we are year to date. Now, of course, year to date, I mean, pretty much it shows you the story of like everything else. We had COVID-19 issues. But if we move the chart to, say, for example, the 1 year, here we are. If we look at the 2 year, which, I mean, it tells you part of the story. But then let's get that healthy 5 year going through. Now, from what we can see here, like I said, the same thing when you look at 2018, we saw that same activity just like what we saw in Nvidia. And since then, it's 2019 was quite beautiful. I mean, it had some issues along the way in its earnings because I think they had readjusted their guidance or their forecast for the 2019 year, but they pretty much snapped back. Now we're getting ready to be going into an earnings season, and I wanted to put this out there. Don't be surprised if you hear, say, for example, a lot of companies sandbag, or what we call sandbagging in their forecasts or in their guidance, which pretty much means that they're going to give you low guidance, saying that, okay, hey, we're going to probably not do as well over the next quarter. And then next thing you know, when you notice Q4, you'll see them knock it out of the park. You typically see that a lot happen during Q2, Q3 quarters when it comes time for earnings. Now, a company like Nvidia, when they report earnings, just one thing I forgot to mention, even though they knock it out of the park, their performance and their earnings, there's typically a sell-off, and then next thing you know, after that, 2 weeks later, the stock rallies to another high. In Best Buy's case, they're still trying to get back to their new normal, which is one of the very few companies that have survived COVID-19, or that has also survived the retail space, a la against Amazon and the rest of the other players, and they've done it beautifully. They handled themselves very, very well also during the COVID-19 crisis with their curbside pickup, which was huge because, I mean, I hate to say it, but every single other Best Buy that I went to, there was always a line outside waiting for folks to pick up whatever they needed, especially if you were working from home. And if Amazon, I think when Amazon's logistics was a little bit thrown off, Best Buy definitely picked up the slack where Amazon had left off and allowed you to just go pick up whatever you needed. And Antwoine, if you have any questions, feel free to drop some in there. But like I said, I like where they're going. I definitely think that they're going to blow past this $90 price and go on to a new high. But I think that what the rest of the market is waiting for is for them to show it within their earnings. But anywhere from short term to long term, this is also a position that's very bullish. And one of the things, like you had mentioned, Antwoine, was that you were looking at retail. This is definitely a position, along with other retail players, that you should definitely look at if you're looking to add towards your portfolio.
Just from a technical standpoint, it looks like, you know, I'd be interested to see if it breaks past this $90 point of resistance here.
Yeah.
Looks like it has some support right at around 75, 78-ish.
Mm-hmm.
So, I mean, I would definitely agree with you that, you know, a buy here with maybe a price target of 115 or something, and maybe a stop down there around 72, 73, maybe 75 if you want to be more conservative, is good. I agree that, you know, there's a lot of money in people's bank accounts right now, and consumer electronics is always, you know, a boom product. And then we're still moving into the fall. My concern though is that, you know, like everyone else, man, this second wave that's hanging over our head, are people going to be standing in line, you know, in November, in December, in the middle of flu season, when they can't get into a Best Buy store? And is Best Buy going to improve their online shopping experience? Because it's still not as smooth as Google Shopping. It's still not as smooth as Amazon.
I agree.
You know, so there's still those points of friction where I want to see them make some major breakthroughs in order to believe in this company past, you know, a 110, 115 price point.
I agree with you 100%. All right. So this one's a little bit more riskier out of all, say, for example, the positions that currently exist, and that is Draftkings. Now, we probably heard about it on some short level positions, but here we are year to date for DraftKings. So pretty much they started as, there's not very much tail of the tape for this company. So given that you're going to be in, say, for example, DraftKings, this is kind of like a more recently IPO company. But the reason why I say pay attention to this company is because of the fact that it may not even be for 2020, but you may be getting this at a steal, because currently right now there's a lot of bearish sentiment for this stock, which could be for your gain. But when we look at the mid to long term, it's pretty much between bullish / neutral. And the only reason why there is because of the fact that we see pretty much a lot of the sports environment that's pretty much still on hold. But this would be, say, for example, if you're looking at one of those 5-year to 10-year positions, especially when we think about where, say, for example, sports betting is going, you definitely are, if that's an area in which that you're really thinking about or as an opportunity, then you definitely want to look at DraftKings. But like I said, right now, it's currently at a risk, because I think that ultimately, if you're interested in this position, you don't have to go buy it tomorrow. But to buy that, say, for example, anywhere from 30 to roughly 36 is good, especially while we don't have sports, because when we do get to sports, we'll definitely see sports betting climb up. And I think that, like I said, they will be at the top.
I like DraftKings. I thought this was supposed to be the year for online fantasy, online betting.
Oh, man.
The NBA is really embracing it. The NFL has really embraced it. And I mean, this is a digital native company that already has brand equity with the players. So, I really do think it's cheap. And it doesn't even matter that there's, some competition in the space right now. There's some other upstarts, but with the capital, with them already being, having an IPO and having capital on hand, they could actually just play the acquisition game if there's some exciting people that can add something to their platform. So I do think this is a good long-term hold.
All right, moving on. Stop me at any point in time, Jolene, if somebody has any questions for me.
I will.
The next one that we have is Advanced Micro Devices, a la AMD. Now, I'm a huge fan of AMD, but at the same token, it's like I don't get too emotionally tied to any company. Though of course, many of you guys know that I know the story and I love the story of the company. But here's where I'm looking at it. All roads lead for AMD pretty much towards the end of this year when we see PS5 and Xbox release. And then on top of that, if Google Stadia starts to mature a little bit better, then we're definitely going to see some impact there with AMD's position. I think that also what they're doing with their chips, as it pertains to, say, for example, the data center space, they're still in the process of taking up more market share. And now that we just heard from Apple that they're going to be making their own silicon chips, at the same time, AMD is still going to be the graphics provider for Apple devices as it pertains to Mac Pro and iMac machines. So, and I don't see that changing anytime soon, because of the fact that what AMD does on an actual digital media graphics processing versus even its competitor in Nvidia. Nvidia is best when it comes to gaming graphics. AMD's best when it comes to digital media development and design. So I think that the world is very, very bright. I think that AMD is toiling through this resistance period. They did have a small little correction that was pretty silent. If we're looking over the 1-year chart, we see that there is this period of time that it's kind of like been trying to find its footing, but typically it's been hanging around this. It's found its support here first, and then it kind of dipped below here. So I don't think it's going below 49. But what I think, though, is if we can break past this 56 price, more like 55.50, this stock is definitely going to break out. And my next price target for AMD is at 60.65. Oh, just for anybody that also wants to see the 5-year chart, I mean, pretty much. There you go. No questions there?
I think my only comment on AMD is that, I like Nvidia more in this space for exactly the reason that you pointed out, is the data center play. When you look at Google Cloud, AWS, and even Azure, you're seeing Nvidia making really big moves to have custom hardware on those stacks and available. So they're not a one trick.
That's a Turing architecture, right?
Yeah. So I like Nvidia a bit more in this space.
Okay. And then I'm throwing out a wild card, y'all. I'm going with China. I'm going with China. I like it for the next three that I'm going to pretty much bring out, because I'm actually going to give you guys something special today. I'm going to talk about, these are my 5 picks, but I'm also going to, just like how we play in spades, there's also the possibles. So, and with that, it starts off with, say, for example, KWeb, which is a Chinese internet company ETF. Don't worry, y'all, Luckin Coffee is not involved here. What I do like is, say, for example, we've gone through a lot of issues, and what you're seeing here on this chart, it does look kind of ugly when we look at, say, for example, its trend due to a lot of the issues of not only just coronavirus, but we also had U.S.-China trade relations that were, I mean, pretty much they've become pretty sour, but everybody's trying to save face here. But looking at it though, and I've been watching a lot of Alibaba and Tencent and a few other companies like TSM, which is in the semiconductor space. They're on a roaring comeback, and many of the other companies within that space are also following. So here's the 1 year. I mean, just so that way we can show everybody. And then of course 2 year. And then here we are at 5 year. Now we're getting ready to break past, say, for example, this, where we're at 68 back in, I want to say, what was that? January 22nd of 2018 was once where it hit its high. And then ever since then, we've been dealing with issues of US-China trade war. But keep in mind, as we move forward into an election year, and that we may be seeing some changeover for election year, don't be surprised if you see China literally roar back and literally go a lot higher. I think that a lot of these companies, especially companies like Tencent, Alibaba, JD.com, the sky is pretty much the limit for those companies, especially since what they're doing, not only in China, but also in other areas and other geographical locations. Now, mind you, that's my possible. All right, so these are my possibles. Another one that I want to look at is, say, for example, IGV, which is the tech software sector. Now, if you like what Antwoine was saying, that he was looking at indexes, and this is a beautiful index. I mean, I know a lot of folks hear me talk about XOK, but this is even far more beautiful. It's a little bit more of a price premium, at a higher price premium than XOK, but it's definitely worth it based upon the companies that are in it. I'll definitely tell everybody that some of the same companies that you'll see in XOK are definitely here. But you'll also see other companies that are also, that you don't have in XOK, they're here. So a lot of those innovative new tech, internet or tech software companies, they're here. Now looking at it, I mean, just like pretty much everything else, you're going to see this dip. So I want everybody to just get used to seeing this because of what we've had to face this year. But look at how the stock has roared back, and now we're sitting at an all-time high. That's not just by happenstance, that's by the power of, say, for example, the tech space. And it's not always going to be the fact that we're always going to show you a tech company here. It just means that tech, in my belief and in my analysis, from here until, say, for example, January of 2022, tech is literally going to be leading the market. The market will not move unless tech is moving. And if tech is not moving, then we're probably headed towards some form of a bear market unless the other spaces can pick up the slack. And I just don't know any sector that can really pick up a lot of the slack that tech brings to this space. So here we are with a 1 year, here we are with a 2 year, and then here we are at a 5 year. Doesn't that just look beautiful, by the way?
It does. It does. I worry, to your point, I worry where all this capital goes, right? Like, I mean, clearly some of it has to go back into cyclical consumer goods, like it has
Mm-hmm.
to, right? Like those companies aren't going out of business. Everybody kind of rushed out of them because, people aren't outside and things like that. That will change. And I think you're going to see really good buying opportunities for tech stocks right now. Like I said,
Yep.
I'm not buying tech stocks today. They're really
Mm-mm.
expensive. There's a ton of cash flowing into them. But I do think once the market kind of rebalances itself, we'll see
Mm-hmm.
buying opportunities for ETFs like this.
Yep.
There is a question here.
Hit me.
Kanar wants to know: do more companies in an index make for a better buy rather than one that has less?
It depends upon the type of index, and feel free, Antwoine, if you want to piggyback on this one. I mean, because not all indexes are created equal. Some have very poor performing companies, though, that they're jam packed with tons of tech companies or other companies that are in it. I think that you have to look at the quality, and they typically say look at the top 15 or top 20 companies that are there and look at their weighting. If we're talking about equal weighting, then that can change perspective. But if we're talking about cap weighting, and that's the difference between, say, for example, specific ETFs. I mean, long story short, I mean, if, say, for example, if you have more companies in there, it could possibly save you as it pertains to, say, for example, the blow that you take that day. But in perspective, though, when we think about it in reality, if you're talking about if tech is down, then tech is down.
I think for me, Mark is absolutely correct on the weighting. Like, look at. I think a lot of these index funds are going to be the same for their top 5, right? There's, you have your mega cap tech stocks that any tech sector is gonna hold, and then you kind of want to look at the correlation of the other companies below that, because that's gonna kind of affect how extremely these things move, right? If the bottom 20 trade in tandem with Apple and Microsoft for some odd reason, then you're not really getting the benefit of it being an index fund, right? You kind of want stocks that are picked and have kind of decorrelated price action in these types of funds, and it's the exact same thing in mutual funds. This is all like portfolio theory, right? But the way to really tell that at a glance is to just look at kind of what sector these guys are working in. So, for example, like Nvidia is going to be really tied to like what an Alphabet or what an Amazon is doing. AMD is going to be really tied to like what a Sony is doing. So there's really no point in having both of those in the same index, because they're going to trade together. One is the component of the other. So I think those are some of the things you might want to look at when comparing some of these. And I think for me, the one thing I want out of an index, sort of like for me, it's like a mutual fund with lower cost, right? I don't necessarily want these sharp moves when the market moves. I kind of want it to be a little bit more muted, and that's
Steady
up
Eddie.
and down. Yeah, that's up and down. And so, you're not always going to beat out, if you had just picked the top 5, which right now it's hard, because you're not going to, if you were in Amazon, Apple, and Microsoft, that's pretty much the only place you needed to put your money for the last 6 months. You can be as clever as you want. If your money was in those 3 stocks, then you're up, some ridiculous percent. I put my money in Microsoft in March, got lucky, didn't try to call a bottom, just that's when I had some cash to put in it, and it's up like a ridiculous amount. I think the intelligent part now is like, when do I start taking money off the table? And I don't think we're there yet. So yeah.
Also, one of the things that we forgot to mention is be sure to watch the volume. I mean, as it pertains to like some of the ETFs, especially when some of them are like what Antwoine said, some of them are seen where when you look at the top 20 positions that are in each ETF, you got to look at like, and I said that not all ETFs are created equal. So you got to look at the volume. Like, for example, I know that in XOK, it typically trades at about 4 million. Whereas, say, for example, this one trades at about, like, when we say volume, how much buying and selling is taking place. We see in this one, it's about roughly, I think its 10-day average is about 7 million. So that lets you know that there's a lot more buying activity or a lot more trading activity within this ETF versus the other technology ETF.
And the reason that volume matters is liquidity, right? Availability of the price point. So your ability to get in and out at a price that makes sense to you. You don't want it to go from like $79 to $72 because there's not enough price action in the fund. So
there you go. All right, and my final possible is the ETF XSD. So XSD is a semiconductor stock, and so if you don't have the capital to, say, for example, buy into an Nvidia, but you want to have Nvidia, you want to have AMD, maybe even Intel, if you still believe in it, then this is going to be the position for you. That, or Jolene, she has a love-hate relationship with SMH, but but I mean, here's a pretty nice little balance. It's within the same family as some of the other ones like XLY, XLK, XLP, XLC Communications. Not that heavy duty amount of volume until as of recently. When it first started out, it was pretty low volume, but though we had some volume here. But average that what we've seen is about 100,000 versus SMH is about a few million. In shares changing over, but nevertheless, let's look at the performance, and this just kind of gives you a quick heads up of looking at, say, for example, the semiconductor sector. It looks pretty much just in comparison, and I can actually run a comparison to it if I want to do Nvidia. So I'll do that comparison, and we'll make this a much more defined color. So we'll put that at red. So if we look at it in comparison to Nvidia, they pretty much, Nvidia has been killing the game versus this ETF. And then when we look at it, though, that again, still steady Eddie. And keep in mind, this ETF is a lot younger than, say, for example, Nvidia. So it's only been in existence since 2015. And so I think that it's just getting started. But based upon where I'm seeing, it has a nice little steady up trajectory. So for those in whom wish that, for those that want to have their proper up downs, their up down days, I think that this one would be perfect. It's pretty well balanced. But so just as a comparison to, say, for example, its counterpart, SMH, which is another ETF. I'll make it purple this time. So here we go. As you guys can see, they pretty much move practically the same. It's just the price action is just different in SMH. So when you look at, say, for example, SMH's volume in comparison, well, it's not going to show it to us today, but if you get the chance, just go look at, if you have your CNBC app, just pull up the 10-day average volume in SMH versus 10-day average volume in XSD. And those are my picks.
Question.
Go ahead. I was gonna drop this in, but I'll answer it after the question. Go forward, Jolene.
So earlier we were talking about earlier, as in a couple hours ago, we were talking about correction.
Oh yes, I'm glad for anybody that stayed along in this conversation. They definitely want to hear this, so that way they can learn about corrections. So you want me to just go ahead and educate the people on corrections?
Yes, sir.
All right, so a correction is pretty much when you're sitting at the highs, so kind of like what we're sitting at right now. So you see a lot of companies sitting at their 52-week highs. And so typically a correction is where we fall 10% below the 52-week highs. Now, is that to say that that's going to happen tomorrow? No. I mean, I don't have a crystal ball to tell you, but I will tell you this. When the ways that you can foresee a correction to give you some kind of perspective, corrections, they say on average come every 16 months. Now, of course, we've had COVID-19 that literally corrected the entire market completely and sent everybody into not only correction, but tailspin and panic. But where we're at right now, we're sitting at the high highs. We've just broken past some of those early highs where we were early in the year. So we've reached new highs. And like Antwoine said, we're still not done, probably going up a little bit further. But I think that as we get towards earnings, which is next month, you will probably be seeing some of these companies and some of these sectors correct about 10%. And so here's the thing. Corrections typically take anywhere from 14 to 30 days as it pertains to process. Now, of course, we're in a totally different market. We're dealing with fractional shares. We're dealing with a lot of options trading. We're dealing with a lot of volume. So for all we know, it can go from anywhere from, say, for example, 5 days to 7 days or 5 days to 14 days. The market has just significantly changed. But all in all, you're going to face a correction. Now, if it goes beyond 10%, and let's say we go to 15 to 20%, that's no longer a correction. That's called bear market. And when you're in bear market territory, that means that we're in a seller's market. And that means that essentially bear versus bull, when people are bullish and they're more inclined to buy, they're definitely motivated to buy. When they're bearish, they're motivated to sell. And so when we enter into bear market territory, you start to see folks unload. Now, when we go beyond 20%, that's just panic. That's just panic. Or say, for example, your company is just not who they say they are, like a Luckin Coffee, or, you know, like a lot of your airline companies, we thought that they were strong and they were not. That's like the Boeing falling 60% because of, say, for example, being hit with a double whammy of 737 MAX, as well as COVID-19 and other airlines. So that's beyond bear market. That's just ultimate catastrophe. But what we like to say is just focus on, say, for example, correction. Now, the beautiful thing about a correction is, like Antwoine says, that opens up opportunity for potential buyers as well. So for folks in whom which that have been priced out, that haven't had an entry point into the market, that have said, okay, hey, how can I get in? All right, now is an opportunity to do so. You just have to pick your spot. You have to strategize and say, this is where I'm going to buy. And I always say you got to have an entry point and you got to have an exit point. If you don't have any of those, then ultimately you're kind of lost. Did I miss anything?
I think the old adages of, like, you know, buy the dips in the bear market, in the bull market, and sell the tops in the bear market, it really just kind of gives you your strategy, right? If the overall market is in a downtrend, which we haven't seen for over 10 years at this point, you know, then you sell the rallies. And I don't know that those things still hold true in the world of algorithmic trading, in the world of such dramatic price action. I really think you have to start rethinking, you know, how the market works, because when those adages existed, you didn't have algorithms that would hit switches and instantaneously sell off, you know, 15% of billion-dollar positions. It just didn't occur like that. And now that's the majority, you know, JP Morgan Chase, Goldman Sachs, all of those trading desks now, you know, have you know, algorithmic traders, data scientists, quantitative analysts sitting there writing these things up. So the price action is just going to
pretty much people like Antwoine, by the way, people.
It's going to move so fast. And, you know, I think we really have to rethink the entire strategy of you know, day-to-day, even week-to-week trading. I think if you really want to look at dips, then you really have to look at, you know, a monthly or a quarterly type time frame.
I agree with that 100%. And one of the things that we typically see when we're on the verge of a correction, typically when you see that, it really just defines exactly how uncertain the market really is. So when the market becomes very uncertain, or when things are, say, for example, you typically hear it a lot when we go into a correction around the same time when we start seeing a few of the major players where their earnings are just crap for the quarter. We typically, historically, when you look at it, pretty much we correct. And when we correct immediately. I always say, look at it, and for those in whom which that don't know what earnings is, think about earnings as like every 4 quarters, it's like a company's report card. So think about it like your kids, where it's like, if you have children that are in school, or if you remind yourself back when you were in school, when your parents were asking you, hey, how's school going? Oh, it's going very, very well. Everything is good. And then the real comes out where, say, for example, now it's all about like, all right, so now it's put up or shut up time. What did you really get? And then that parent is expecting like you got a 3.5 to 4.0. but in reality, you got a 2.0. It's just different. All right, so that's pretty much it from my side of the spectrum. Do we have any more questions for us, or can we go have dinner?
I don't take questions, but it would be great if you are still game to drop the link.
Oh yeah. So for those folks that have stayed on board, if you would like to, because we noticed that there's a lot of Apple folks in the group. So if you would like to have access to the beta, which they just released for iOS 14, then I will drop that link in there. Now, be cautious. This is a beta, which means things are buggy. It's not final. They're going to make improvements. But if you're a person that likes to be pretty much in on the technology and it kind of gives you a glimpse of what's to come, definitely go ahead and, at your own risk, go ahead and download those profiles, and then pretty much it'll walk you through of how to add iOS 14 to your device. I'm loving it. I'm actually using it on this device right now that I'm actually doing the Zoom call on for my iPad. And on top of that, I'm loving the new iMessage features. But yeah, so I'll drop the link in the I'll drop it on a posting for the come up, so that way anybody that wants access will have access.
Marcus has a question. He says, I think it's falsely. Any thoughts on falsely?
On who?
It looks it's FSLY.
Oh, is that Fastly?
Fastly.
Let me pull it up real quick. All right, so looking at Fastly, it's a brand new publicly traded company, of course. So looking at it, it's had a nice little spike, a brilliant spike. I will wait for the stock to settle down a little bit. I think it's going to settle down at 70. But I mean, phenomenal company. But yeah, I will wait for the dip here.
All right.
I would definitely be buying that on the dip if you're thinking about doing it as a stock trade. But I don't think that they're in the market long enough for an option trade. And yeah.
Marcus, let us know how that turns out for you.
Please do.
Well, Antwoine,
all right.
Thank you so much for joining us today. It was really fun, really insightful. I like how we go back and forth. And
thank you so much.
Thanks, Jolene. Thanks, Mark. It was absolutely a great time. Look forward to doing it again.
Yeah, I would love to have
for sure. We're definitely gonna have you back. So I mean, we may have to come down there for a special Oakland episode.
Please do.
Just to come check it out, and then we'll do live down there.
Please do. I look forward to seeing you guys. Maybe we can do it up in Napa.
Oh, I mean, now you're saying some things, man. I mean,
back to
man. Yo, bang. Just kidding.
Yeah. Well, you guys have a great evening, and look forward to talking again.
Yeah, thanks
brother.
All right.
Bye, y'all.